Hello, thank you for joining us for our quarterly investment perspectives review. My name is Aldo Voltaggio, and I'm the Chief Investment Officer at Capstone Financial Advisors. First, a quick market review. Stock and bond markets broadly declined in the third quarter amid the continued rise in interest rates. For stocks, it was a reversal of their strong positive return trend over the prior 9 months. Bullish sentiment faded, partly due to forward-looking corporate guidance that was generally pessimistic ahead of a weakening economic outlook. But despite the recent retreat, both U.S. and international stock markets have maintained year-to-date gains. Meanwhile, the bond markets continued facing headwinds as interest rates climbed further due to persistent economic growth and above-average inflation. Year-to-date, the U.S. bond market is down slightly, but international bond markets have broadly maintained their gains because interest rates abroad haven't moved up as much as U.S. rates this year. Heading into the final months of 2023, notwithstanding an unexpected macroeconomic shock, material stock market declines will likely subside. In our previous quarterly market review, we noted that stock market valuations have increased materially amid bullish investor sentiment. However, the just over 9% sell-off in stocks that started from July 31st market year-to-date high through the end of the third quarter led to a material retreat in bullish investor sentiment. According to a recent sentiment survey, the percentage of investors with a bullish outlook on the market fell from its highest level since April 2021, 51% bullish, down to 28% bullish. In other words, the recent pullback in stocks has already removed a lot of market froth and tempered investor euphoria. Stock market gains could resume in the fourth quarter if earnings keep coming in better than expected, and if more companies and sectors beyond large capitalization technology stocks start performing better. As we mentioned in our previous quarterly market review, outsized gains in large cap tech stocks, partly due to expectations around AI, contributed nearly all the aggregate stock market gains this year. The performance of many other sectors and areas of the market have been negative to only slightly positive, including less profitable, less expensive value stocks, and most mid and small capitalization stocks. Broader stock market participation would likely occur if economic growth remains positive, inflation continues cooling, and interest rates stop increasing. With regard to the outlook for bonds, we think the bond market volatility investors have experienced for the last several quarters should stabilize soon. The significant rise in interest rates over the past year and a half has pushed yields on long-term U.S. Treasury bonds, which are benchmarks used for home mortgages and other essential borrowing rates, to their highest levels since 2007. In October, the benchmark 10-year U.S. Treasury bond reached nearly 5%, which the Fed will likely view as enough to keep inflation under control. At this point, it's fair to say that Treasury yields have mostly priced in a higher for longer scenario, which should remove a key source of downside volatility for the bond markets going forward. Furthermore, bond markets are priced to deliver higher positive long-term returns. For future bond market performance is primarily due to higher starting yields in the 5 to 7% range that investors can earn on high-quality investment-grade bonds. Secondly, because of the declining trend for economic growth and inflation, we are much closer to the end of the current rate hiking cycle. The longer central banks keep rates high, the longer investors have to benefit from higher bond yields. Moreover, when the economy and inflation slow enough, central banks will inevitably start to cut rates, resulting in bond price appreciation. On the economic front, U.S. economic growth was strong throughout most of the third quarter. The economy accelerated somewhat relative to the year's first half, amid solid consumer spending, improved manufacturing activity, and a tighter job market. Initial claims for unemployment insurance, a gauge for labor market strength, indicates how many people have recently lost their job. Jobless claims fell throughout the third quarter after trending up throughout the first half of the year. This economic strength has led to caution from the Fed, which recently indicated that it doesn't want to cut interest rates too quickly and risk flaring up inflation again. After a sharp slowdown in inflation earlier in the summer, progress in bringing inflation down stalled somewhat in August and September, with headline inflation coming in at 3.7% in both months. Looking abroad, higher interest rates resulted in a meaningful slowdown in European economic activity in the third quarter. European service sector activity declined throughout the third quarter, while manufacturing sector activity remained lackluster. Although growth has slowed meaningfully in Europe, the health of the European employment market has remained strong, with unemployment rates at or near all-time lows. This is supporting consumer spending. Meanwhile, China's economic recovery remains challenged on multiple fronts. A drawn-out real estate crisis continues to hurt the economy, while consumer spending remains lackluster, and exports have declined amid cooler overseas demand for Chinese-made goods. However, more recent economic data has shown signs of stabilization. Deflationary pressures, that is, falling prices, have moderated the last 2 months. Manufacturing activity expanded in September for the first time since March, and travelers made more domestic trips during the 8-day National Day holiday than in 2019, the last pre-pandemic year. Looking ahead, the U.S. economy will likely see slower growth in the next few quarters, but a recession, if it happens, will likely be mild and not until next year. Consumer spending faces challenges from higher gas prices and interest rates and the restart of student loan payments. However, because many households have low mortgage rates locked in and stable employment, consumer spending should remain positive. The Federal Reserve is committed to keeping inflation at 2% and will probably hike interest rates by 0.25% this year and maintain them well into next year. In Europe, economic growth is expected to remain weak, with declining business activity and falling inflation. Both the European Central Bank and the Bank of England are likely to halt rate hikes. Recession risks persist, but stable employment should support consumer spending in Europe. In China, economic challenges continue, but there are signs of potential stabilization. Policy stimulus will focus on reducing interest rates and addressing real estate problems. The upcoming third plenum will provide insights into policymakers' actions against economic obstacles. The recent attack on Israel and its tragic consequences have far-reaching political and humanitarian implications. For investors, the resurgence of geopolitical conflict adds to uncertainty surrounding markets and the economic landscape. Geopolitical conflicts, like the Russian-Ukraine war, have shown that they can significantly impact markets and economies. In the case of Russia's invasion of Ukraine, it led to a surge in prices for critical commodities, exacerbating global inflation. This in turn prompted central banks to raise interest rates, negatively affecting bond and stock prices. However, the disruptions in global energy and food markets eventually resolved, leading to price stabilization, and stock markets have recovered materially, despite the war still ongoing. The current Israel-Hamas conflict in the Middle East may result in higher oil prices and potential global inflation if it escalates further. The extent of its impact hinges on whether conflict remains contained or spreads, potentially involving Iran and affecting Saudi Arabia's oil production plants. However, if the world's oil supply remains largely unaffected, the war's impact on global inflation and economic growth should be limited. The current macroeconomic conditions are more favorable than when the Russian-Ukraine war began in early 2022. Today, inflation is decreasing, global economic growth is still positive, and interest rates are relatively high, giving central banks more room to cut rates should economic conditions materially worsen. From an investment perspective, trying to time the markets around geopolitical events is challenging due to numerous uncertainties. The ongoing Russian-Ukraine conflict is a prime example of this. Geopolitical events and their market impacts are unpredictable. Therefore, long-term investors are advised to maintain diversification and balanced portfolios, stay disciplined, and consider rebalancing when opportunities to buy assets at a discount arise. The implications of recent events are still unfolding, and we continue to monitor them closely for potential impacts on commodities and the broader financial markets and the economy. Our portfolio recommendations are shaped by current market conditions and long-term investment perspectives. We recommend taking advantage of the current opportunities in real asset securities. Publicly traded real estate securities and infrastructure securities have notably lagged behind broader stock markets due to a rapid rise in interest rates over the past 18 months. These securities are sensitive to interest rates and have been declining in price and are now trading at significant discounts. This underperformance has provided attractive opportunities for new investment, as well as tax loss harvesting and portfolio rebalancing opportunities for those who have already held such positions. Within stock allocations, we advise investors to take a defensive approach by favoring profitable companies with strong cash flows that are relatively inexpensive. These firms are less reliant on now costly debt financing and are expected to perform well amid higher interest rates and can better weather economic challenges thanks to their strong balance sheets. For bond allocations, we recommend that long-term investors consider high-quality, intermediate-term bonds in anticipation of a potentially challenging economic environment ahead. Such bonds, often rated as investment grade, are better equipped to withstand economic slowdowns. Additionally, intermediate-term bonds with a 4 to 7 year duration offer more attractive interest rates than in recent years and typically appreciate in value when central banks start to discuss implementing interest rate cuts. Lastly, market pullbacks like the third quarter decline offer opportunities for long-term investors. Looking forward, a slowing economy is likely to impact corporate earnings growth, potentially increasing stock market volatility. Rising interest rates could also pressure both stock and bond markets. Nevertheless, investors should focus on their long-term goals and use market downturns to buy assets at lower prices, even if it feels unsettling. This disciplined approach can enhance portfolio returns over the long run.
Thanks for watching. For more information on this topic, click the link in the description below.